So I now request our President, Sri Makon Chandra Haldar, to please give the formal welcome address to kick off the proceedings. Thank you.
Thank you. Good evening, everybody. We are organizing the webinars regarding the 2022 budget and its implications. Due to the pandemic situation, it is not possible for us to conduct this type of discussion physically. In this budget, the rate of income tax has remained the same, but numerous changes have taken place in this budget. Our Honorable Finance Minister, Mrs. Nirmala Sitharaman, has introduced some new sections in the present budget and also has made amendments in various sections. We have invited our former President, Mr. Sajjan Kumar Tulsiwan, to this webinar as the speaker. He is a renowned lawyer practicing all over India, and he is highly respected and successful lawyer in our fraternity. So I feel that there is no need to provide any further introduction of our learned speaker. I am sure that his deliberation on this topic shall clear the various aspects of the current budget. Today, our speaker will certainly clear all the doubts to the satisfaction of the entire audience. I would like to mention that the moderator in today's meeting is Manoj Kataruka. He is a young, energetic, and promising lawyer in our field. I would not like to extend my speech any further. So I would like to hand over the proceedings to Siddhartha and request him to continue further. Thank you.
Thank you, Mr. President. As we are already informed, the Secretary of the Income Tax Bar Association, Calcutta, Sri Manoj Kataruka, he would be the moderator for the webinar today. I once again request all of you, please keep yourselves on mute mode until and unless you are asked to unmute. Manoj, I would now ask you to unmute and carry on with the proceedings to start the show and moderate today's budget discussion. Thank you so much.
Thank you, Siddharth. I, on behalf of the Income Tax Bar Association, Calcutta, welcome all the participants who have joined in this webinar on the direct tax proposal in the Finance Bill 2022. The Honorable Finance Minister has laid down this budget keeping in view the India's growth vision in the next 25 years when India completes 100 years of the journey of independence. During her speech, she has mentioned only a few provisions, but there are altogether around 82 amendments which have been made. And as much as I am eagerly waiting to hear Shri S.K. Tulsiwan sir, who is very experienced, abundance of experience in this line, I'm sure all the participants are also waiting. So without wasting any further time, I would hand over the proceedings to S.K. Tulsiwan sir in respect of the budget analysis. Thank you.
Respected President, Income Tax Bar Association, Sri M.C. Haldar, Secretary, our dear Manoj Kataruka, Siddhartha, other office bearer of ITBA, my learned friends and colleagues at Bar. Today's webinar has been organized by Income Tax Bar Association to enlighten our members in respect of the budgetary provision in respect of the direct taxes in the Finance Bill 2022-23. This exercise of bringing a finance bill along with the money bill has become a perpetual practice from the time of the Congress UPA government, and it continues like that, leading to passing of the finance bill direct tax proposals without much discussion, and therefore Parliament has been reduced to a stamp on the working of the TPL of the CBDT. Therefore, we find every year a number of amendments are proposed, and one which was brought only a year before is also subjected to large amendments. So in any case, we being the citizen of this country and Parliament being the enactment body of the law which leads to taxation in India, have no other option but to sit across and discuss what has been put in the budget proposal. Now, in regard to the various budget proposal, which my coordinator and the secretary has already mentioned, are around 86 in numbers. These amendments, many of them are having far-reaching consequences. I'll start with a very small thing where my honorable president was led to believe that there was no change in the rate of tax, but there is some change in the rate of tax also, which I like to highlight at the beginning. In the case of cooperative societies, earlier up to 1 crore, there was nil tax. Now, and 1 crore to 10 crore, there was 12% rate of tax, which has been reduced to 7%, and above 10 crore, 12% has been retained. Likewise, in the rate of alternate minimum tax under section 115 JC, it was 18.5%, which has been reduced to 15%, and consequent amendment has been made in section 115 JF. Now, in this regard to surcharge on the long-term capital gain, in my case, it used to be 37%. So now it has been plagued at 15%. So that is a welcome provision, leading to the surcharge being 15% on the long-term capital gain. Likewise, AOP existing of only companies as members, rate of surcharge shall not exceed 15%. These are the only changes as far as the rate of tax is concerned. Now, the most lauded amendment, which the Honorable Finance Minister said so in her budget proposal, was giving a window of opportunity to those who have failed to declare their income fully in the 2 preceding assessment years. They can update their return either within 12 months or within 24 months. In respect of 12 months updating, the provisions has been brought that 25% tax then further to the normal tax will be charged, and in respect of more than 12 months but within 24 months, it shall be 50% tax which will be charged. I'll deal with the other requirement of updating the return, which are mostly the disqualification for the updation. But what is wondering to me is that when you update a return which has already been filed, you do not withhold those transactions which are duly recorded in your regular books of account. You therefore do not update those transactions which are either in cash or are in the nature of loan, bogus share capital, or any investment which has been failed to be taken care of, or any expenditure which you have failed to take care of, or an investment which is recorded in the books but full value of that has not been disclosed, or any money, bullion, jewelry, valuable article or thing which has not been fully disclosed in the return which you furnish normally under section 139. Now question arises, if you update your return in respect of any of these items, the question arises, in the assessment, what will be the consequence? If you disclose a transaction which is outside the books of account, but which has been conducted in cash. What will be the implication of it? Implication of it, entire expenditure which has been incurred to earning that income shall be added under section 48(3) if this expenditure is more than 10,000 rupees of each of these transactions. Likewise, if you have not deducted tax on certain expenditures which you have made of business nature, under 48 IA, that expenditure will also be disallowed. So what will be left with will be the income which you have offered to tax. In that also, if you are not able to substantiate that income shall be treated as unexplained receipt. If it becomes an unexplained receipt, it will become a cash credit under section 68. If it becomes a cash credit under section 68, what will be the application? You will be charged to tax, which will be including surcharge 75%. If you further add 25% tax on that, then it will reach 100%. Then if you have to pay interest under section 234 A, B, and C on that, then it's 100%. But if it is more than 12 months, within 24 months, then it shall be reach 125%. And the interest, etc., including, it will reach 150%. So what type of, because there is no explanation, there is no information, what type of income in the updating of the return can be taken care of. There is no such suggestion that if you disclose any income, question will not be raised, because it shall, such a updation shall be only a voluntary disclosure. If it is a voluntary disclosure, then why assessment? Why don't you accept that income as it is declared in the return? No further question to be asked. There is no such suggestion in respect of updating of such a return. So therefore, this is bound to fail unless the government comes out with any assurance or with the circular that in updation of such income will not be asked to give the source, that the income declared will not be further scrutinized, that the amount of asset pursuant to the disclosure of such income created will be accepted. So these are the areas, gray areas, in respect of updation of the return as far as the 12 months and 24 months window has been given under section 139(8)(a). Now, the returns which can be revised can be either having been filed either under section 139(1), 139(4), or 139(5). But there are certain disqualifications and there are certain prohibitions. The disqualification is if you had filed a loss return and you want to update it, returning into reduction of the loss, you will not be entitled to update the return. If your tax liability is still decreased by virtue of updation, then you will not be allowed to update your return. And if it results into any refund or increase in the refund due to the updation, that also will be prohibited. You will be prohibited from doing that. And there are other disqualifications, like if it is not applicable to the assessees, in whose case search under section 132 has been initiated, or requisition under section 132A has been made, or survey under section 133A has been conducted, except under subsection 2A, which survey is in respect of the TDS. Then books of account, document, money, bullion, jewelry, valuable article or thing belonging to them or pertaining to them have been seized in course of the search of a third person, then these persons are also disqualified from updating the return. Then then there are other disqualifications, like AO has information that such person for relevant assessment year is proceeded under PMLA or Benami Act or the Black Money Act, a Smugglers and Foreign Exchange Act, and same has been communicated before updating of the return. And there are information from the foreign destination under section 90 and 90A, and it has been the information has been received prior to the updating of the return, or any prosecution proceeding is pending under chapter 22 in the case of the SSC in respect of any years. So in all such cases also, or there are other disqualifications which can be notified by the board apart from these disqualifications. So the updation is also dependent upon so many disqualifications which has to be negative before you can update your return under section 139(8)(a). Now there is a new section incorporated under section 140(b), wherein the computation of tax has been laid out. As per that, if you have filed the return under section 139(1) and 4, tax payable shall be computed after taking into account the following: that is, tax paid as advance tax, TDS or TCS, relief of tax under section 89, relief of tax under section 90-91, relief or tax under section 90A, and tax credit under section 115JAA. And over and above that, whatever further tax is required to be paid shall have to be paid. In a case when the return was furnished under 139(1), 4 and 5, tax payable shall be computed after taking into account amount of relief or tax under 140A1, because if you have paid the self-assessment tax at the time of filing of return, that then TDS, TCS, relief under 89, relief under section 90-91, relief under section 90A, tax credit under section 115JAA, which has been claimed in the return, and total taxes to be paid in all these cases will be tax payable to be determined above along with the interest and late fee, additional tax to be paid at the rate of 25% of the aggregate tax, and interest if the return is furnished within 12 months from the end of the relevant assessment year, and additional tax 50%. So these are the provisions which has been laid down in section 140B, as per which a valid return under section 139(8)(a) can be filed for updating thereof. But as I told you, I have got lots of doubt about the success of this scheme unless the government comes out with new enabling provisions or new enabling circulars to make it possible for the SSCs to avail this scheme which has been announced by the government. So let us hope that we will have something good in future in relation to that. Now comes the second most important amendment which has come in section 2, subsection 47A, and introduction of section 115BBH. You all know that the issue of cryptocurrency has been something which has been playing up in the mind of the people, and lots of discussion has preceded the introduction of this subsection and provision to tax that in the Income Tax Act. The amendment does not talk about cryptocurrency. It talks about this digital currency. It talks about non-fungible token. It talks about token of the similar nature. So digital asset, as the central government may by notification the official gazette specify, will be the asset which will cover the cryptocurrency also. So therefore, such asset which is described as non-fungible token and which will be duly explained by the government notification in the official gazette. In this respect, a provision has been incorporated whereupon on the transfer of it, the resulting gain or deemed gain shall be charged to tax at the rate of 30%, and such 30% tax will be on the income which shall be receipt minus cost of acquisition. So there will be no further expenditure which will be allowed. If there is a loss in that, then that loss will not be carried forward or allowed to be set off against any other asset or any other income. Section 194S has also been introduced, as per which 1% tax will be deducted by the person responsible for paying to the resident any sum by way of consideration for transfer of the digital asset, but no TDS if the amount payable does not exceed 50,000 rupees in the case of a specified person and 10,000 rupees in case of non-specified person. A specified person has been defined are individual or HUF, where total sales, gross receipt, turnover does not exceed 1 crore in the case of business and 50 lakh in the case of profession in the immediately preceding financial year. Individual or HUF not having any income under the head PGBP. So a specified person, if they have received up to 50,000 rupees, the TDS will not be applicable in their case, and non-specified person 10,000 rupees. Otherwise, TDS shall be deducted at the rate of 1%. Another very important amendment has come wherein non-obstinate provision has been introduced in section 14A. As per that, a explanation has been inserted, and the section 1 has been amended to say that notwithstanding anything to the contrary contained in this act, for the purpose of computing the total income under this chapter, no deduction. So now the provision is non-obstinate, it is a standalone provision. So therefore, this cannot be overridden by any other provision. And so the disallowance now, if you have made investment, the resulting income therefrom will be exempt from tax. So even if that exempt income has not arisen during the relevant assessment year, the expenditure relating to the investment made in such exempt income shall be disallowable under section 14A of the Income Tax Act. This provision comes into play from 1st of April 2022. A welcome provision has been brought by the Finance Minister in relation to COVID-related expenses. Section 17, subsection 2, in the definition of perquisite, it has been clearly stated, and which is brought from 1/4/2020, that any sum paid by employer to employee for his medical treatment in respect of illness relating to COVID-19, subject to such condition as central government may by notification the official gazette specify, not part of the salary. So this will not be treated as perquisite. There will be a notification on the quantum which shall be permissible and the amount so received, which will be covered as per the amount specified in such notification. The amount shall not be treated as perquisite and will not be charged to tax. Likewise, in section 56, subsection 210, an amendment has been brought with effect from 1/4/2020 by inducting subclause 12 and 13, where it has been provided that by an individual from any person in respect of any expenditure actually incurred by him on his medical treatment or treatment of any member of his family for any illness related to COVID-19, subject to such condition as the central government notification, the official gazette specify in this behalf. So it is again dependent on the notification to be given by the central government. But in any case, such amount is spent by the person or received by any person shall not be charged to section 56(2)(10). And by a member of the family of the deceased person, from an employer of the deceased person, or B from any other person to the extent that such sum in aggregate does not exceed 10 lakh rupees. So if a person is already dead and he has received from the employer from any other person up to the rupees 10 lakh rupees for the treatment shall not be charged to tax under section 56(2)(10). Then where the cause of death of such person is illness related to COVID-19 and payment is made received within 12 months from the date of the death of such person and subject to such other conditions, central government may by no official gazette specify in this behalf. So now you are aware the matter was in the Supreme Court where certain amount is to be paid to the person who died post-COVID. Then provision of compensation is there. Such a compensation is being paid by the state government and the central government. And now I think this has been kept in mind that within 12 months when this amount is received, then it shall not be charged to tax under section 56(2)(10). And therefore these provisions have been incorporated. Now a very, very important amendment which has been brought in this finance bill is in respect of amendment in section 170. Subsection 2A has been inserted. So far, Saraswati Engineering, Maruti Limited, and so many other decisions, the Supreme Court has held that if a order has been passed on a non-existent entity, then the assessment on such non-existent entity will be non-est. And therefore, any demand raised pursuant to such an assessment shall not be valid and therefore not recoverable from the SSC, and therefore such an assessment will not have any force in the eye of law. But in order to overcome that, a amendment, this subsection 2A in section 170 has been inserted, which says in case of a business or reorganization, amalgamation, demerger, merger of business or one or more persons, assessment, reassessment, other proceeding made on predecessor during the course of pendency of such a reorganization shall be deemed to have been made on the successor, and all provision of this act shall apply accordingly. Pendency means period commencing from the date of application and ending with the date on which the order is issued by the PCIT or the CIT. It means during the pendency of the application before the NCLT or before the High Court, if any order has been passed by the assessing officer or any other authority in the name of such a non-existent entity, then such order will not be treated as valid and shall be treated to have been passed on the successor. But I am very amazed that section 170A also has been inserted side by side, as per which new section says that modified revised return of income after reorganization to be filed within 6 months from the end of the month in which the said orders was issued. Now, if they validate the orders of the merging company, as having been served on the company in which it has merged, then what return they will file? It means there will be separate assessment order. What will happen if you validate that demand? Then what will happen to this return? By assessing this, will you create new demand? Will you pay that demand and this demand both? No clarification in this respect has been given in the bill. So therefore, there should have been a clarificatory amendment in section 170A, as per which if the order was already passed and that is declared to be valid under section 170, then the entity will not be required to revise the return, and that return which was originally filed by both the entities shall accordingly be assessed, and thereafter future returns shall be filed post merger. But as against that, there is validation of such assessments. At the same time, section 170A says the revised return of income or the reorganization can be filed. So 139(5) has been done already. Now, if the order is received after 4 years, then after 4 years such a revised return can be filed, taking into consideration the merge and the merging unit. So both the income will be clubbed, and then a revised return shall be filed. So the income will be assessed on that basis. Then what will happen to these assessments? So there is a confusion in respect of that. Hope there will be some clarification in respect of this. Now, another very important substitution of section 144B, which has been made. I'll come to that later because it is a huge rewriting of the section, and there I have to deal with what was existing and what is in the new, or what is the consequence of it in the hands of the SSEs. So that will take some time. So for the time being, I am skipping that. But the only change which this 144B has brought is the deletion of subsection 9, as per which if the procedural letdown in section 144B was not followed by the faceless assessment authorities, then that assessment is to be declared a nullity. And many high courts have also passed the order on those lines. But the subsection 9 has been deleted, but nothing has been addressed if there is failure on the part of the faceless authorities to observe the guideline contained in section 144B. I'll come to that later, wherein I'll explain to you what was earlier, what is now, and what are the changes which has been brought. Now, I come to provision of section 148 and 148A. My friends, you all are aware, last year, there was a partisanship in the provisions of section 147, 148, 148A, 149, 150, and 151. And it looked that government has decided to put the provisions of reopening in a very dynamic mode. Therefore, each and every action of reopening was subjected to the approval of the higher authorities, and at each stage, the checks and balances were let down. But within 1 year, the government have a rethinking, and they are also thinking of increasing the area for reopening. The zeal to realize more and more taxes at the cost of the SSEs in a manner which suits them most is really not understood, because we are not a banana republic. We are a democracy, largest democracy in the world. There has to be consistency in the approach of a government of the size, which is elected by more than 86 crore electorate of this country. And look at the amendment which have come in section 148, 148A, 148B has been brought in, and 149. Now, what is 148 amendment? In 148, second proviso inserted, which provides that the order is passed under section 148A, then no approval is required from authority as specified under section 151. Now, this is an amendment which is proposed. And so earlier, before issuance of notice of so-called on the basis of information collected, this was subjected to a scrutiny by the specified authority defined under section 151. This has been done away with. So there is no checks or balance now on the assessing officer in issuance of notice under section, the issuance of so-called for initiating proceeding under section 148A. Now, definition of information which earlier existed also has undergone change. Now, which has been made retrospective, and it has been made effective from 1/4/2021. The information under explanation 1 with retrospective amendment says flagged word is removed. They say flagged is a mistake. How can flag, which has been so much highlighted in the section, can be a mistake? So unless all informations as per the old provisions could not have been used for reopening of a concluded assessment, but flagged information was only, which was to be flagged by the CBDT, was the basis in provided in section 148A, but now flagged word is removed. Information now include any audit objection. Now, earlier the audit objection was the Auditor General final audit objection was to be taken. Now, mere audit objection can be the information. Any information received from a foreign jurisdiction under an agreement or direction contained in a court order under section 90 and 90A, earlier it was also there, it is here. Then information received under a scheme notified under section 135A. This is new provision which has been brought in. Section 135A was enacted during the COVID period, and as per which all those information which has collected under section 133, under 133B and 133C, they are all coming under section 135, and this section will be abolished once all those informations are brought into the notification. No such notification is issued till date. Now they say all the information which will be notified under section 135A will be the basis for reopening of the assessment. So it means every type of information which you collect, whether it is verified, unverified, or it has been subjected to a scrutiny, non-scrutiny, can fall under the provision of section 135A and can be the basis for the reopening now. Any information which requires action in consequence of order of the tribunal or court, that earlier was also there. So these are the information which can lead to the reopening under section 148 and initiation of proceeding under section 148A. Deemed information as per explanation 2 also has been extended, and the 3 years cap which was there has now been removed. Earlier, the AO shall be deemed to have information for the period of 3 years immediately preceding the assessment year, relevant to previous year in which search is initiated. Now the period of 3 years has been removed from the date of its inception from 1/4/2021. Now AO shall be deemed to have information of reopening on based on as per section 149. So now there is no need to go through under section 148A, or 3 years cap is not there for the entire period of 10 years. The only thing is that there should be the discovery of the asset or expenditure or any noting in the books of account or document which will lead to reopening as per the new defined provision of the escapement. So now come to the amendment in section 148A. Earlier, the opportunity was to be provided with prior approval of the specified authority. After amendment, prior approval has been done away. Provision of 148 not to apply in case the AO has received information under section 135A. So 148 will not apply. 135A has been given primacy. So all the information is collected under section 135A pursuant to inquiry under section 133, 133A, 133B. All these will be falling within the ambit of section 135A, and there will be reopening without recourse to section 148A. So the flag of section 148A has been removed on that. A new section 148B has been incorporated. where the search assessment or recomputation under the Act shall be passed by the assessing officer below the rank of joint commissioner, except with the prior approval of the additional commissioner. So all 148 assessment now shall have to be done as per section 148B with the approval of joint commissioner or the additional commissioner or joint director or the additional director. Now section 149, there are certain amendments in section 149 also. Time limit of 10 years was applicable only where the income chargeable was represented in the form of asset has escaped assessment. Earlier, the only escapement was when you have not disclosed asset and undisclosed asset was found pursuant to the information contained either in the search conducted of the SSC or conducted elsewhere, or on the basis of information received in respect of such an asset. But now this has been expanded, and it now expanded definition includes expenditure in respect of transaction or in relation to an event or occasion or any entry or entry in the books of account. So these are the additions which has been made on the basis of which the information shall be taken and escapement will be presumed. First proviso of section 148 and 148A cannot be issued on or after 1/4/2021 if a notice under 148 could not have been issued. Now, earlier it was clear that beyond 6 years from 1/4/2021 for the assessment years were not to be issued under section 148 because of the first proviso. But there was no mention of section 153A and 153C cases. Now 153A and 153C cases has also been brought within the ambit of this explanation proviso 1. As a result, in the case of 153A and 153, there are provisions of relevant year. As per that, 10 years assessment could be reopened, provided the asset of the description described in section 153A relating to those years are also found. So now on the basis of the 153 and 153C provision, the reopening under section 148 can be even for 10 years because provision of section 153A and 153C has also been taken in the first proviso. Then they have inserted subsection in proviso, subsection 1A in section 149. Earlier, this 50 lakh rupees was the escapement for each assessment year. Now, if an expenditure, say, has been incurred which pertains to 4 years, 1 year it is 10 lakh, another it is 20 lakh, yet another year it is 5 lakh, then yet another year it is 20 lakh, but in aggregate it is 50 lakh, then all these years assessment will stand reopened as per the subsection 1A which has been inserted. So therefore, the 50 lakh rupees limit in respect of reopening of each assessment year now has been done away with by introduction of this subsection 1A, and therefore all those years which are covered, but if the aggregate amount of escapement is 50 lakh rupees, then all these years assessment shall stand reopened. So these are the new additions which has been made in section 148, 148A, 149. Therefore, the area of escapement has been largely expanded by virtue of these amendments which has been proposed in the finance bill. Now coming to the other most important amendment is in respect of the charitable institution. Section 11, Section 12, Section 13, Section 12 AA, Section 12AB, Section 1023C, Section C 4, 5, 6, and 6A has all been hugely amended to provide for various disciplines and various regions for which registration can be cancelled. So many new compliances has been added, leading to running of a charitable institution made so difficult, because charitable institutions basically are run by people who work gratuitously, and they give their spare time in looking after the activities of such institution. To expect from them that they will have to bear such a huge burden of compliances will really lead to disincentive in the running of the NGOs and doing the charitable work. The 10th proviso to section 1023C. Now, maintenance of books of account has been made compulsory. Similar provision has been incorporated in subsection 1B of section 12A. Earlier, there was no such requirement. Only audit report was to be submitted in respect of the charitable activities. Now, the incorporation of maintenance of books of accounts and documents has been made compulsory for all cases of section 11, 12, or 1023C, 4, 5, 6, and 6A. Now, another amendment which has been proposed in the 15th proviso to section 1023C, and similar amendment has been proposed in section 12AB4 in respect of cancellation of registration or approval. Now, registration or provisional registration of a trust or institution granted under section 12AB1, ABC, or 12AA 1B, or section 1023C6, 4, 5, 6, and 6A, and subsequently, if the principal commissioner has noticed occurrence of one or more of the specified violation during any previous year, the principal commissioner or commissioner has received reference from the AO under second proviso to section 143.3 for any previous year, and such case has been selected in accordance with the risk management strategy formulated by the board. Even the cases which are selected in accordance with the risk management strategy formulated by the board, the principal commissioner or commissioner shall call for such document information, make inquiries for recording satisfaction, pass an order cancelling the registration or refusing to cancel the registration after providing reasonable opportunity of being heard, and if is or not satisfied that one or more of the specified violation has taken place. Forward copy of the AO to such trust and institution. You are aware the cancellation of registration or approval in the case of the trust or institution. Even now under section 1023C also this provision has been now brought in, will lead to taxation of the entire wealth of this institution at the market value on the date of the cancellation of registration under section 115TD. So you have also provided that such case has been selected in accordance with the risk management strategy formulated by board. Even before reaching any conclusion, the action for cancellation of registration can be started and done. So these are the very great dampener which has been introduced in the finance bill. The specified violation which has been provided in the bill means where the trust or institution under second regime has income which has been applied for object other than for which it is established. Say, I have been established to run a school, but if I have given relief to the poor, that could be treated as a violation. Likewise, if I have given some medical service during the COVID period, then that will also be treated as violation as per this provision. The income from profit and gain from business, which is not incidental to the attainment objective of separate books account or maintained. Now, if I am running a business which I feel it is for the attainment of the main object, but the department feels it is not for the attainment of main object that could lead to the cancellation of the registration. Applied any part of the income from property held under trust for private religious purposes which does not inure for the benefit of the public. Now say you have a hospital, and outside the hospital you have built up a small temple, because the patients who go to the hospital, they take the blessing of the God before entering the hospital. Likewise, those who are treated and they get well, they also go to the temple and take blessing of God and then go back. So the temple has gives a spirit to the patient for recovery, and also gives the spirit for further well-being. But if a hospital, say even a school also maintains, or any such charitable institution maintains a temple or a church or a gurudwara or a mosque, then that will be a disqualification and cause for cancellation of registration. Or applied any part of income for the benefit of any particular religion or caste. So the caste in India are synonymous with the community. Jat, the Gujjar, or Banya, or Brahmin, they are not caste in general. They are the community and they represent the masses. But as per this provision, if you have applied it for any particular caste, then it shall be violative of the charitable object. Activity carried out is not genuine or is not in accordance with all or any of the conditions subject to which it was registered. Now, there will be all the time requirement of proving that my all activities are as per the object clause, that we have not violated any object clause, that all the expenses which has been incurred are in consonance with that. So these are the reasons. He has not complied the required any other law. Now, which other law? Now, you see, so there is too much pressure which has been put up on all the charitable institutions to comply. And it is very difficult for any charitable institution to comply all such stringent conditions. So therefore, all the institutions will be in perpetual fear that their registration may be cancelled. And such an order which is started proceeding by the principal CIT or CIT shall have to be concluded within 6 months. So therefore, if an information has been received and that information under section 135A is yet to be used in the assessment, but the order shall have to be passed within 6 months. If the PCIT decides no, it is violative, then he can pass an order cancelling the registration. Then another feature which has been brought is, apart from cancelling the registration, under section 11.3, you are aware that under 11.2, if we are not able to make 85% of the expenditure required under 11.1 of the receipt of that year, then under section 11.1, we can explain that the receipt, etc., being delayed, we will spend it in the next year. That is explanation 1. And under 11.2, if you want to build up any big structure, say I want to create a building for which I have to accumulate for 5 years, so that accumulation I can do. So if for that a permission, we have to give an information, and then I can we have to utilize it within 5 years. Then now 11.3 has been incorporated, that if I don't use it within 5 years, then it shall be treated in an income and shall be charged to tax under 11.3. Then explanation 3 has been inserted in section 1023C, with effect from 1/4/2003, where 85 income under section 1023 is not applied wholly and exclusive for the object for which the trust is established, but is accumulated or set apart either in whole or in part for application of such object, then such income so accumulated shall not be included income of the previous year or person in receipt of the income of the following conditions certified. Furnish the statement in the form of manner prescribed thereof, stating the purpose of accumulation, and money so accumulated is set apart and it is kept in 11.5 form, and such a statement is furnished before the due date of furnishing or return of 139(1). So this is a new provision which has been added in section 1023C, whereupon the benefit which was used to be given under section 11(2) to a trust registered under section 12A has been extended to section 1023C also. Now explanation 4 also has been inserted. If the income referred to in explanation 3 is applied for the purpose other than wholly for the object for which the trust or institution established or ceases to be accumulated or set apart, then and ceases to, then again this 11 explanation 4 is a provision is per which if I don't comply with that, then it shall be treated as income as in section 11.3. So a corresponding provision has been brought in section 1023C also. Now explanation 5 has been inserted. Where say I have not been able to use that money for the above purpose, but I want to use it for some other purpose, then I can write to the assessing officer and I can explain the circumstances under beyond my control. The accumulated income for such other purpose could not be. Say I wanted to buy a building in Park Street, and I had estimated when I started that I shall be able to buy it for a sum of 5 crore rupees. But now in 5 crore rupees, a building of that size is not possible to be bought in the Park Street. So therefore, I decide, no, I shall start a school in say New Township. And for that, I acquire a building there, or I acquire a property on hire there and build up a school. And for that, I provide all the infrastructure, use that money for that purpose. So if the assessing officer is satisfied with my explanation, then he can permit us to do that. So that is a explanation 5 which has been inserted. That is good. Now, the 20th proviso to section 1023C, which has been inserted, is that all the returns under section 1023C 4, 5, 6 and 6A shall have to be furnished in the income tax return under section 139(4)(c) for claiming exemption. So this is just a procedural provision which has been incorporated. 21st proviso to section 1023 inserted. This 21st proviso says where income or part of the income or property of the trust or institution has been applied directly or indirectly for the benefit of any person referred to in section 33, such part of income or property shall be deemed to be the income of such person. So you see, you know that 13(1)(c) is a provision in the Income Tax Act where the interested persons, if given benefit, the trust or institution is hit by section 13(1)(c), and such persons are specified under section 13(3). So if 13(3) any expenditure is incurred on any person under section 13(3), then this provision says that shall be charged to tax in the hands of the trust on institution, similar to the provision contained in section 13(3), and therefore the trust will be, or the institution shall be assessed on that amount. Then section 13 and section 1023C6 both have a new subsection inserted, is section 10, subsection 10 in section 1023C, that where provision of 13(8) are applicable to any trust or institution under the second regime, or such trust or institution violates condition prescribed in section 12A(1)(a)(b), and income chargeable to tax shall be computed allowing the deduction for expenditure. Now they laid down a procedure that how you will assess the income of a trust which has violated the provision of section 13(8), they say that you assess the income of such a trust by allowing deduction of expenditure which they have incurred for earning of the income in the trust in a commercial manner. And you also allow depreciation on the capital asset used by them in the earning of such income if they have not already used the value of that capital asset as application of income under section 11(1). They also say that the expenditure which is incurred by the assessee should not be incurred by borrowing loan. So if you have borrowed the money and used that money for incurring this expenditure, then you will not be allowed that deduction. Such expenditure not to fall any contribution donation. So any contribution or donation given by the charitable institution to another charitable institution shall also be not allowed a deduction in computing the income of such an association or institution which has failed to meet the requirement of section 13. Now section 13(1) inserted no deduction in expenditure or allowance of set off of loss. So now even the loss will not be allowed to be set off if you have violated section 13(1). 22nd proviso under section 1023C inserted. This provision is inserted though 22nd proviso of 1023 for violation of the provision of the 18th proviso and violation of the condition prescribed under 10th and 12th provision. So this is all consequential to those amendments. Now section 115 BBI takes as the special rate which has been incorporated. Now tax rate on trust or institution under section 1023C 11 will be charged at the rate of 30% on a specified income, and balance income normal or old rate of tax will be charged. So what are the specified income? A specified income are those income which has resulted because of violation of the payment made to the person who are under section 13(3) of the Income Tax Act, and similarly the proviso enacted in section 1023 4, 5, 6 and 6A of the Act. So therefore all such amount which has been paid to such interested persons will be subjected to tax at the special rate of 30%. Now we come to 80G subsection 2B. Explanation 1A to the third proviso of section 20C inserted. Explanation 3A to section 11(1) inserted. Voluntary contribution for renovation and repair of temple. Now a new provision in 80G has been incorporated where if a voluntary contribution has been received by a association or an institution who is having temple, mosque, gurudwara, church, and at the option of the trust or institution, if such a donation received for the repair or construction of the temple, mosque, gurudwara, etc., although voluntary in nature, they can treat that as corpus and apply such corpus only for the purpose for which the voluntary contribution was made. Does not apply such corpus for making contribution or donation to any person, or maintain such corpus is separately identified unit, and invest such deposit, such corpus forms the modes specified in level 5. So if these 4 conditions are satisfied, then those donations will not be treated as voluntary donation. They will be treated as corpus donation, and they will not be subjected to tax under section 11(1)(b) of the Income Tax Act. So this is a welcome relief given by this new provision which has been incorporated in section 80G2B. Now, a new penal provision has been incorporated under section 271 AAE. Now, as per which, if a violation under section 13(3) has been noticed and that income of the trust or institution has been brought to tax at a special rate, then in the first violation, 100% penalty shall be imposed under this new enacted section 271 AAE, and if later on it is noticed that there is a second violation, further violation, then it shall be equal to 200%. So this is a new provision, but I don't understand if the first violation itself leads to cancellation of registration, then that trust itself will lose the status of a charitable institution. So where is the question of imposing 200% penalty on the second violation? So therefore, this is another thing which is baffling me. Now, you are aware that 115 TD is a section which was introduced in assessment year 15-16, as per which any trust which violates the provision of section 13(3) read with section 13(1)(c) or 11(5), there they will lose registration, and the day they lose the registration, the value of the asset owned by them shall be subjected to tax at the normal rate under section 115 TD of the Income Tax Act. But 1023C trust and institutions were not covered by it. Now 1023C trust or institutions have also been brought in within the ambit of section 115 TD with effect from 1/4/2023. Now there are miscellaneous amendments which are to section 37. An explanation 3 has been added, as per which any expenditure incurred for the purpose which is an offense or which is prohibited by law shall include or deemed to include the anything which is prohibited by law, or to provide any benefit, perquisite, or whatever form to person, whether carrying on business, practicing profession, or acceptance of a benefit and perquisite in violation of law, shall also be coming within the definition of prohibited by law and shall be disallowed. And another, if you have incurred any expenditure in compounding of any offense under the law, will also be covered by it. So therefore, the definition of this explanation has been expanded by incorporating these three limbs of the explanation, and therefore now any such expenditure will no more be allowable as deduction in computation of your income. Now in section 48(2), a retrospective amendment has been made from assessment year 2005-06. This is the result of a very learned and very good order passed by our judicial member, Sri Garg, in the case of Kanodia Chemicals and Industries. He discussed what is cess and what is surcharge, and he also discussed why cess and surcharge form the part of the tax. So he said, education cess is also a cess and nothing but tax, and therefore it is not deductible in computation of income. Prior to that, Bombay High Court, Rajasthan High Court, and several tribunals all over the country had categorically held that education cess is not a tax and it has been collected for promoting education. So therefore, it is deductible in computation of income. But that judgment has been quoted heavily in the budget and the explanatory note, wherein he has held that the impugned orders passed by the high courts and the tribunals are per incurium, because earlier the Supreme Court has examined the similar issue where the Supreme Court has said such cess or surcharge are part of the tax and therefore not allowable as deduction. So this is the result of this judgment of Kolkata Tribunal, and I compliment the Honorable Judicial Member for writing a very learned and wonderful judgment. And although it is against the SSC, but since this is the law, there is nothing for us to complain. Now, Section 43B, an amendment has been made. Wherever the interest was due to a bank and ultimately under an arrangement or an agreement that loan, that interest was converted into either equity or debenture or preference shares, it was deemed that the interest has been paid, and such payment of interest was treated as deductible in computation of income. It has now been clarified and stated that with effect from 1/4/2023, such a conversion will not be treated as payment of interest and shall not be allowed as deduction. Section 50, an explanation has been inserted wherein the reduction of goodwill of a business or profession from the block of asset in accordance with Section 43(6)(c)(2)(b) will be deemed to be a transfer. Now, what will be its implication? I have not been able to gauge so far, so I rest my discourse on this issue to this only. Now come to Section 56 amendment. There is a amendment in Section 56 to 7B to include fund regulated by International Financial Services Center Authority Act 2019 within the for consideration of Section 56 to 7B, and as such this amendment has been proposed. Another very important amendment which has been made in Section 68. So far we knew Section 68 was amended with effect from assessment year 13-14, wherein the issue of shares at a premium was considered by the issue of shares or the premium by a company, receipt thereof was required to be proved by not only proving identity, creditworthiness and genuineness of such credit in the hands of the receiver, but also in the hands of the investor. So the source of the source concept was brought in from Section 13-14 in respect of the share subscription, but this has now been extended to loans and advances also. So therefore still more regulatory hardening of approach has taken place on the part of the department. Now Section 79 amendment has been made, which says Provision 71 shall not apply to an erstwhile public sector company subject condition that the ultimate holding of the company where 51% of the holding is not disturbed in the public limited company in a disinvestment. Provision of Section 79(1) will not apply. This is the amendment which has been brought in. Section 79A has been brought in, wherein it has been said that if I have earned any undisclosed business income and that business income has led to assessment in my hand and I have got carry forward losses and carry forward depreciation, then that will not be set off against that income. It has been provided in section 79A. Say disqualification is incorporated for setting up with the brought capital with the business loss and depreciation in computation of my income. Now section 80 CCD has been incorporated. Contribution of pension scheme, the state government employees has been raised from 10 to 14%. 80 DD annuity payment benefit of the dependents in disability up to attaining the age of 60 years or more has been given. 80 IAC 1 year extension has been given to 31/3/2003 for the startup. 80 LA has been transfer of ships also has been brought into it. 92 CA faceless provision has been extended from 31/3/2022 to 2024. Section 94 provision of bonus stripping in 94A was applicable in the unit. Now provision applicable to the securities, stocks and shares also. 115 BAB tax on the new manufacturing unit also has been extended up to March 2024. 115 BD tax on dividend receipt from foreign enterprise, now concession has been removed. 119 section 24F has been added. 132(8) word order of assessment order has been substituted by order of assessment reassess. So 147 also has been included in section 132(8). So earlier since 153A, 153C assessments have been done away with. So 147 has been incorporated as a consequence because such assessment will be made under section 147 only. Now section 144 applicable case updated under section 8A of section 139 updated case has been brought in. 144C proposal for faceless scheme in the case of TP provisions has been extended up to 31/3/2024. 153 there are amendments wherein the assessment under section 254, 263, 264 shall be passed within 9 months from the end of financial reach. Order 154 received or passed with the PCIT. 9-month time has been given. New section 5A inserted. You have to modify order of assessment, reassessment within 2 months from the receipt of the order from TPO under 92 CA and under section 263. So 263 cases, TPO cases, when 2 months time has been given. 153B provision will not apply in the case of search and requisition one. So after 153B is not applicable because 153 or 153C are not applicable. 156A now has been incorporated to deal with the cases of IBC where the NCLT says these liabilities will no more be recoverable. So 156A says this demand will be reduced and new demand notice will be issued. 158A is applicable up to April 2022 and new provision of 158AB has been brought. Identical cases, there is no need for filing of appeal if the SSC agrees to that. So such an appeal will not be filed before ITAT, High Court, and that has to be done on within 60 days from the receipt of the order. If the SSC do not agree to such a proposal, then the appeal will be filed. Then 179, title of section has been amended, liquidation word has been removed. Then TDS provision, 194 IEA, now the duty will be 1% will be deducted on the stamp duty value. 80R, now section 28(4) provision, any benefit, there will be deduction of tax above on if the gross sale exceed 1 crore and business or 50 lakh in the profession, then ATR 10% will be deducted on the perquisite value. 201 in the case of a specified person, provision of section 200 will not be applicable, and section 206 AB and 206 CCA, TDS and TCS on the non-filers. Those who use not to file the return, in their case 20% TDS used to be deducted, and 2 years consecutive if they have not filed the return, then this provision is applicable. This is reduced to 1 year. If you have not filed the return for 1 year, then 20% deduction shall be made. Then this 206C, interest to be paid in according to the order passed by the AO under section 206(6)(a), and 239, a new section has been inserted. The refund under section 195, you have to pass an order now. The AO has to allow on the application made to and he will pass an order as per which the refund will be granted, and if he rejects that, then appeal provision has been incorporated. Then 253 faceless in the case of tribunal has been extended up to 31/3/2024. In the case of 263, provisions of 263 have been made applicable to the TP provisions also. And since these orders are approved by the commissioners, the chief commissioner will be doing that 263 in these cases. 271AB, 271AC, and 271AD has been extended to give power to the CIT appeal also for levying of the penalty. 271A, new section has been incorporated, where in the case of violation under section 13(3) or under section 1023(c)(4)(5)(6)(6)(a), the provision shall be applicable equal to the sum which has been assessed in the hands or equal to the amount of tax which has been charged from them. 272A2, penalty has been increased from 100 per day to 500 per day. And 285B, new section inserted with effect from 1st April 2022. Section 285 to include persons engaged in a specified activity to expend reporting requirement under section 52A. So 52A requirement has also been extended to such person. These are the basic provisions which has been brought in by the finance bill. I had told you I shall be reverting to the provisions of section 144B in relation to the assessments to be made under section 143(3), 144 or 147. Now I like you to look at the screen where old 144B provision and new provision both have been listed by me. You can have a look at this, and I'll be explaining to you accordingly with reference to this chart. Does not section 144B provision does not exist. Now new provision is any FSC shall assign the case selected for faceless assessment to a specified assessment unit. Earlier it was not there. This has been brought in. In clause 3, after the issuance of notice under 143(2), now clause 2, any FSC shall intimate SSC that his case is selected for a scrutiny. Without issue of notice under section 143(2), NEFC will inform the SSC that his case is selected for a scrutiny. Then NEFC shall serve a notice under 143(2) specifying the issue selection of his case. SSC will have to respond to NEFC within 15 days. Now NEFC will serve 142, 141, SSC and file reply within the date which shall be forwarded. So 2 days time, 15 days time has been done with. Now NEFC to intimate SSC that covered by this clause. So I am not referring to these clauses. So now I come to 11, where SSC fails to comply with notice 142(1), 142A shall issue upon such SSC notice 144, giving an opportunity to so called by assessment in this case should not be completed to the best of his judgment. Now it says where SSC, new provision, where SSC fails to comply to notice 143(2), 141, NFC shall intimate such failure to the AU. Well, first of all, they will intimate the failure to the AU, and the AU through NEFC will serve upon SSC a SCN under section 144. Why assessment in this case should not be completed to the best of his judgment. Then the SSC to furnish response within the time specified in notice to such extended time to NFC. SSC to furnish response within the time specified in notice on such extended time NFC, which shall forward it to the AU. So earlier there was no such provision of forwarding to the AU. Now it will be forwarded to the assessment unit. And 12, 13, where no response filed under 144, this will intimate such failure to the AU. Where no response filed 144, this shall intimate such failure to the AU, same provisions contains. Then come to 12, which is not there earlier. then the AU, after going through all the relevant material on record, shall prepare in writing an income or loss determination proposal. No variation, prejudicial interest of the SSC is proposed, then send it to the NEPFC. If variation, prejudicial interest of the revenue is proposed, revenue not is SSC is proposed, then SCN to be issued to the SSC. Then 13, SSC shall file reply to SCN within the time specified therein, or such extended time to NEFC which shall be forwarded to the AU. 14, where no reply is filed, NEFC shall intimate such failure to the AU. Then 15, the AU, after going through all the relevant material on record, shall prepare in writing an income or loss determination proposal and send it to the NEFC. The proposal is a new provision, new concept. Then 16, upon receipt of income or loss determination proposal, NEFC may convey to the AU to prepare draft assessment order, assign it to the RU review unit through automated allocation system to conduct review. And 17, RU shall conduct review of the income or loss determination proposal and prepare review report and send it to the NEFC. And then 18, NEFC shall forward the review report to the AU. These are all new provision incorporated in section 144B. Now 14, AU, after going through all the relevant material on record, shall prepare a draft assessment order and send it to the MC. This is old provision. Now the AU, after going through all the relevant material on record, shall prepare a draft assessment order accepting or rejecting the modification proposed in the review report, and the AU shall send draft order to NEFC. Then 15, AU shall, while making the draft assessment order, shall provide detail of the penalty proceeding initiation. It now does not exist. Then NEFC shall examine the draft assessment order in SO risk management, a strategy specified the CVDT by way of an automated examination tool. In case no variation, prejudicial interest of the SSC, issue the final order in notice of initiating penalty proceeding. These are the old provision. New provision is, in case of variation, prejudicial interest of the SSC, as mentioned in 144C1, a draft assessment order, NEFC shall serve the draft order, serve upon the SSC, and 22, NEFC shall convey to the AU to pass the final assessment in case the clause 20 above, and 23, upon receiving the final assessment, FC shall serve a copy of such order and notice for initiating penalty proceeding on the SSC along with the demand. Now they will be initiating the penalty proceeding. Now, no review of SCN proceeding after the draft assessment order, no review of the SCN proceeding after draft assessment order, and final come chapter 24, where the draft order is served on the SSC. Such SSC shall file his acceptance, file his objection to variation with DRP and NEFC within a period of specified 144C. 25, NEFC upon receipt of the acceptance, or if no objection received, shall intimate AU the completed assessment on the basis of the draft assessment draft order. AU shall, upon receipt of the intimation, NEFC pass assessment order, initiate penalty proceeding and send it to the NEFC, where SSC files objection before DRP. FC shall send such intimation along with the copy of objection to the AU, and FC shall, upon receipt of the direction of the DRP, shall forward it to AU. AU shall, in conformity with the direction of DRP, complete assessment in 144C13 and send a copy of the assessment to NEFC. NEFC shall, upon receipt of the order, serve the copy of such order along with the demand notice and notice to initiating penalty proceeding. So these are the now new provisions in regard to the faceless assessment contained in new section 144B, which has been brought into the bill, which is going to become the statutes. So with these with explanations to the various provisions which has been incorporated in the finance bill, I end my discourse to it, and I thank the ITBA providing me an opportunity to put my view on the finance bill, which is in the finance budget presented by the finance minister in the parliament. So therefore, I'll invite, if there is any questions on any of the issues relating to the budget, and I'll be happy to explain if anything is to be explained further.
If there's any questions, please unmute yourself and we can ask sir directly.
Actually, it was a long budget, so I myself had taken 1.5 hours. But there are so many amendments and so important amendments.
Yes. It was with your energy, sir. It was like we were, you were carrying on, and we were thinking, when will this end? It was never ending budget, and for whoever thought that the proposals were far and few, I think I have been wrong. It was very cumbersome. Some of the provisions were so complicated, and
Yes.
which we have entangled so properly with your analysis, with case laws. And I, on behalf of the Income Tax Bar Association, are very grateful and thankful for your pain and effort taken, sir, in preparing and giving this discourse to us. And such complicated proposals have been lucidly explained by you, sir. Thank you very much. I think there are no questions here, sir. So I would request Siddharth to give a formal vote of thanks and close the proceedings.
Thank you, Manoj. No thanks, no vote of thanks would be enough for sir. The way he had been taking this brainstorming session of this such a long, complex budget proposal. Let's look forward to actually gulf it in the next course of time, how much we can get out of it, extract out of it. Thank you, everyone. Thank you, Mr. President, Secretary Sri Makhan Chandra Haldar, Secretary Manoj Kataruka, and our keynote speaker, our past president, Sri Sajjan Kumar Tulsian. No praise is enough for you, sir. Thank you again. Thank you so much. And all the members and other delegates from the Income Tax Bar Association and other associations and organizations. Thank you very much. With this, we'll end the meeting. Have a very good evening and a wonderful year ahead. Thank you very much. Manoj, with these words, I would like to end the meeting for all.
Thank you.
Thank you. The recording of the meeting would be shortly available on the YouTube, and it would be there in Income Tax Bar Association Calcutta channel. Thank you.